Hello, my name is Mike Smith. I'm the president and founder of T&K Futures and Options Incorporated, and today's video lesson is going to be about the cocoa market. But before we get started with that, let's go ahead and cover our risk. Futures and options investing carries significant risk of loss and is not suitable for some investors. Past performance is not indicative of future results, and you should only use risk capital when investing in those type of investments. Okay, I've been trading these markets now going on 20 years, actually 21 or 2, something like that. But the bottom line is, I hear questions all the time from different investors, and they typically end up being very similar in nature. And what I'm trying to do with this educational video is answer those questions as they pertain to cocoa. Okay, the first question I typically get is, how does the margin work for futures contracts? And the margin is set by the exchanges. So they're the ones that decide what the price is going to be that someone has to put up in order to go long or short a futures contract. It's a good faith deposit, they call it, that has to be in the account before you can trade whatever your commodity is that you're going to trade. Now, that's in flux because sometimes if the market is extremely volatile, they'll raise it to try to slow down the speculation and try to decrease the volatility. And there's other times when the markets are very slow and they'll actually lower the margin requirements to try to stimulate more people to get in there and trade, because they make their money when people trade. That's how exchanges work. But so the margin changes. But I looked this up today for cocoa. Today the cocoa margin is $1,430, but that can change based on the volatility of it. Just about everything else, actually everything else, is made up over here. It's just hypothetical, just using it as examples. But let's just say that you opened an account for $50,000 and you went long one May cocoa at $1,000 a ton. Okay, well, what you're going to have left over after that, because that $1,430 goes onto the sidelines, what you're going to have left over is $48,570 in available equity. That equity you can leave in the account just in case the market moves against you. You can, you can get more contracts, you can get more options with it, but that's all you have because the initial margin has to go on the sidelines, kind of held over on the side for you to do any trades. Okay. Cocoa, the contract, it's a 10 metric ton contract, and every dollar is equal to $10. So $1 per ton, $10. So let's go through some hypothetical examples here. Let's say you did get long that cocoa, and let's say the market was at $1,000. I'm using that for easy math. It's $2,800 or something like that right now, but let's just use this, okay? It's $1,000, and you get in, you get long one contract, and the market moves your way by $40. Well, that's 40 times 10, so that's a $400 move to the good. So you got a $400 profit. Let's say you're in there at $1,000 and the market went against you by $40. Well, you just lost yourself $400 per contract. So, that's how the leverage works with the cocoa market. Right here it says infinity risk. No one's ever lost infinity in a trade. But theoretically speaking, if you were short the cocoa market, there's no end to how high prices can go theoretically. So that's why there's theoretically unlimited risk. To the downside, cocoa can only be worth 0. So that's your theoretical risk to the downside. I doubt anyone's going to stop eating chocolate. So I think cocoa will always have an intrinsic value, but the bottom line is, theoretically speaking, it could go down to 0 to the downside. So what you need to take out of this is the futures markets are very risky, and you need to figure out how to manage your risk if you're going to trade futures. And that's the next question, in fact, that I typically get is, how do you manage the risk in a futures contract? Well, I don't know if you can read this, but that says sell stop. If you're long the market, you can limit your risk exposure to the downside by putting in a sell stop order. Now, the way a sell stop works is, As the market goes against you and goes through your barrier that you set, as soon as it goes through it, it turns into a market order. And a market order gets filled at the next available price. So if you notice here it says risk, and we're risking $400, and I put ish next to it. And I did that because you don't really know what the next available price is going to be. So it breaks through your 960 barrier and turns into a market order. Well, the next trade might be 961. Next trade might be 958. Next trade might be right at 960. So you don't know, and that's why there's an ish there. But you know, it limits your risk. It's just not precise where you're going to get at. You just don't know. You just don't know. It's based on the market conditions. But that's how you would manage your risk. In my opinion, that's the best way to manage your risk, is with a sell stop in a long position, and be a buy stop if it was a short position, where you can set your parameters, your risk parameters. The next question I typically get is, what is a call option? Well, a call option gives the purchaser the right but not the obligation to buy the underlying futures contract for a specified time period and a specified price. Well, in this hypothetical, it's a May contract, and the price is $1,040 per ton. And you have to pay for that. You buy an option, and it's going to have a premium is what you're going to have to pay. In this case, I made this up to, I said it was going to cost $150. Well, that's $150 times 10. So, because that's the leverage involved. So that actually cost you $1,500. So let's go through a profit and loss scenario using these hypotheticals. So you bought the 1,040 call while the market was at 1,000, the underlying futures. Went your way. It went up $40. You know, which is a $400 move, but your options are not going to catch the entire move. Options only catch a percentage of what the underlying futures contract does. And what dictates how much that's going to be is your delta factor. Now, I made this up too. I mean, not delta factor, but the price, that is 25%. Let's presume that the delta factor on your 1,040 call was 25%. Okay. And the market moved 400 to the good. Well, 25% of 400 is $100. So your option value only accrued by $100. So now your option, your premium went up from $1,500 to $1,600. Conversely, let's say the market went against you by, you know, the underlying futures went down by $400. Well, roughly 25% is what your delta is. That means now your premium just went down to $1,400. You just lost yourself $100 in premium. And there's an ish next to delta factor too, because as the markets move, okay, that delta factor's in flux. It's constantly changing up and down. So, you know, that's why there's an ish there. There's other factors involved. There's theta, which is your time decay. There's vega, which is your implied volatility. So there's other factors that go into pricing of options, and there's more than that. But you know, this is the one you really want to figure out how much on a percentage basis roughly your option's going to move based on the underlying futures. It's your delta factor that you care about. That's the one that's going to you know, tell you right about what your option's going to accrue or devalue, you know, as the market moves forward against you. Next question I typically get is, what is a put option? Well, a put is just the opposite of a call. It's the right but not the obligation to sell the underlying futures contract for a specified time period at a specified price. Just the opposite. You can bet on markets going down just as easily as you can bet on markets going higher. So, you know, that's what a put option is. It's basically just the opposite of a call. Limited risk. Okay. When you purchase an option, your worst case scenario, whether it be a call or a put, your worst case scenario is you can lose whatever premium you paid plus whatever your commissions and fees were. So that's your extreme worst case scenario. You can't go negative like you can in a futures contract where you can have margin calls and you know, things like that. You're not going to have any margin calls when you're the purchaser of an option. So your risk is finite when you purchase an option. Okay. Well, I think that's about it. If you have any questions, you can, this says tkfutures.com. My name again is Mike Smith. You can go there, my contact information. You're probably already on the website watching this as it is, but you know, that if you have any questions, you can give me a call and I'll help you with that. I wrote a book that's available on Amazon called The No Nonsense Guide to Buying and Selling Options. And as the title suggests, it's all about options. It's an educational book, but doesn't cover the futures, just options. Another thing you might want to do before you invest any real money is we offer practice accounts that give you virtual $50,000 in fake money, you know, that you can use. You download the platform, it gives you the platform bells and whistles with a fake $50,000 that you can practice your futures and options trading with. I would suggest that before you put any real money towards it, just to kind of get a feel, see if you're any good at it. So that's another educational tool that we offer. But that's it. So hope you learned something. Hope you enjoyed it. Have a nice day. Bye-bye.